Several months ago, you had a gold call on this show and you recommended we buy, and those who didn't missed a trick, and the price went up. You've had a $5,000 call on it for the fourth quarter of this year, and now you're raising it. As the market is running in the opposite direction, you're raising it to 6,500. Why? Were you being pulled in with the market? Is it the right call at this stage? Why?
Well, this is the decision, isn't it? This is the time that you either have to choose to lean into your conviction, or, as you say, I call myself out. But look, when we look at the fundamentals, and our thesis all along has been, pretty simple, that when we're looking at the portfolio, we want to have geopolitical hedges. Safe haven assets, treasuries, dollar, gold, are not all performing in the same way, and we do think that gold is the best geopolitical hedge. Therefore, when we start to think about demand, central bank buying has obviously been very strong through 2025. We think those levels are going to continue the same in 2026. And also you have institutional investors thinking about that broader portfolio context and building portfolio resilience. So yeah, 6,500, we think, whilst we're obviously in for a period of consolidation, which we think is healthy, we still think that supply-demand dynamic is going to push gold higher.
Grace, to convince anyone today, you have to convince them the rationale for owning gold rather than just want it in the portfolio, because some are saying, look, what is the argument for central banks to buy more? Everybody may want central banks to buy more, but they've already seen an appreciation in that asset. Why would they bother bulking up in terms of gold ownership at this stage? And retail investors loaded up as well. So what's the rationale here?
Yeah, so I'd say, look, when it comes to the central banks, the developed world is loaded up, as you say. So one of the risks could be that they actually, sell profit-taking. But the EM central banks are not. And if we think about Poland and Brazil as recent examples, there's still a long way to go. When you think about the institutional, or indeed the retail investors, gold is just over 3% of AUM when you think about equities, fixed income and alternatives.
Isn't
and
that
I think
enough?
that could go, no, I think that could go quite a bit higher, actually. People haven't held gold, they haven't held commodities more broadly for many years. From a strategic asset allocation perspective, it hasn't made sense. But now I think we do, and I think a 5 to 10% position, across portfolios is where we could feasibly get to. And when we look at our own clients' books, they're not there. They're not there on gold, and actually they're not there on infrastructure, which is another asset that we think also fits the mood of this market.
One of the criticisms that's been levelled at those who describe Bitcoin and cryptos as digital gold is that it's simply too volatile to be considered a haven or an equivalent of gold. But given the plunges we saw in precious metals on Friday, worst one-day falls for gold and silver since 1980, can we really consider them such safe havens if there's that extreme volatility in one day?
Yeah, I think we've seen the volatility, or the correlation between gold and equities, actually increase, and they've been trading in quite a tight range as we've seen that rally through the fourth quarter and through the beginning of this year. But I do think that you've seen, when you see the risk, the political risk stemming from the US rather than being more broad global risk, that's why I think really gold comes into play and differentiates itself from treasuries and the dollar.
Have you seen any evidence yet of the sell-off we're seeing in gold and silver and crypto as well, and the leverage plays that are involved there? Because we all know there were big margin calls on Friday and beyond as well, having a meaningful effect as opposed to just sentiment on equity holdings elsewhere.
I think it's sentiment at the moment, and I think we also have to think about the broader context. The market was extremely bullish coming into this year.
Remains
so. But actually, when you go back over the last 40 years, volatility in equity markets is entirely normal. You get a 14% drawdown on average in any one year, and yet over that time period, the markets ended up 78% of the time. So to me, this is a bit of a healthy clear out. I'm not seeing signs yet. Robust earnings do need to follow through in the other half of this earnings season for the fundamentals to remain intact. But when we look at the US market in particular, last year's gains were predominantly driven by earnings. And the whole theme that we've had running through last year and this year around portfolio resilience is making sure that you are diversified. Some of that is geographic diversification, but I mentioned before infrastructure as well. This is where you can get great income, but with some inflation protection. We still think inflation is an area that the market's a little bit complacent on at the moment. And so really just looking to diversify bets, but in areas where you've got strong fundamental support is where we're focused.